You might have heard me use the expression, trade your P&L. You have to trade your equity curve. This is kind of a pro concept. I think it's lost on a lot of newer traders, but anyway, someone asked about it, so let's talk about it. Your account balance is dynamic in as much that when you trade and make and lose money, the account balance is going to change. It also changes while you're in positions, right? And so what pros do is they always account for that up to the minute, right? They know where their equity is, and they also know the volatility of the instrument or instruments that they're trading. So instead of coming, a lot of newer traders, amateurs, guys that are trying to make it, newbies, whatever you want to call them, aspiring traders, they might come in and say, "Well, I'm going to risk 200 bucks on a trade." They just pick a number because that's what they're comfortable losing. The problem with that model is that it's not dynamic. It doesn't take into account what the actual volatility of the instrument might be, right? So you could use anything from standard deviation. You could use ATR is very, very popular. Obviously, that's been spoken about quite a bit. And so when you're in the position, you would use the ATR to determine your position size, right? Because you wouldn't want to choose a number that's too big or too small just by picking a dollar sign out of the blue, right? So most pros are using percentages. That's their R. It's not a dollar value, it's a percentage of their account. So let's say that you're risking 0.5%. Only you know what's best, and your account is growing. If your account grows, your 0.5% could be a bigger dollar sign than the number that you're picking off the top of your head. Some places have, they say, well, I only want to risk or lose it up to $1,000 a week. And so I'm going to divide that by, 5 and just pick 200 bucks that way. Personally, I think that way is wrong. Because again, it's too rigid and it puts too much pressure on the trader. And I like to always think in what I call reality. The reality is, the equity curve is an expression in and of itself of how the market's responding to my overall trading ethos, right? I'm not set in my ways per se, but when you evolve into the pro level, right, or you're able to do this and actually make money, you're going to find that you're kind of trading some version of your personality. That's typically how it works, all the while keeping your losses small, of course. And so the equity curve communicates with you. Is your style amenable with what's going on in the marketplace? Yes or no? Because losing money isn't bad. It just means that there's some, disharmony in the short run right there, right? Especially if you know the system has positive expected value. So you can't fall to pieces if you start losing money. It might be aggravating, but, and this gets into a super deep conversation, which I don't want to get into here, but when you lose money, you kind of determine yourself how to label that. So if you get frustrated, it might not be frustrating to somebody else. You see what I'm saying? So for me, it's just like a breeze going by. It is what it is. It's not anything, like I said, to fall to pieces. We tend to label things in our lives so you can recharacterize that event happening in your life and, maybe create a rule around it. Again, I'm not trying to be a psychologist here, but ultimately, if you find yourself being frustrated a lot, it might come down to your very own rules. Your rules might be a mechanism to deliver to you frustration. Yes, I believe everyone can learn how to trade. It doesn't mean that everyone can do it, though. So the dynamism of your account balance having an ebb and flow and the volatility of the instrument having an ebb and flow, you measure those things concurrently and you come up with your position size. It's not uncommon to have a position size, especially if you're trading a larger account where you might have several hundred to several thousand shares. You might have dozens, if not hundreds of contracts. And so as your account balance is growing, right, you might have to trim the hedges. If the volatility expands, right, but your account is the same, you might have to trim the position by a contract or two to kind of keep it within your R, right? So this is really what we mean when we talk about trading your P&L, trading your equity curve. On the downside, it's also very, very helpful because as you start to lose money, 0.5% of a smaller account means less dollars, right? So it's much more flexible, and that would force you to have fewer shares or fewer contracts. Some pros even take it a step further, and to minimize the drawdown, they actually take a haircut on their account balance, right? So if you look at your P&L, could be what is the difference between where you started and where you are right now, right? So with a drawdown, right, where your account balance is lower than a previous high watermark, there are certain inflection points that you can kind of pick. It's a discretionary decision, so that's kind of up to you, but they absolutely work. So for example, let's say that you traded your account up to 100K and then you were down like 2,000 bucks afterwards, or 2%. You might put a rule in that says, okay, at 2%, I'm going to take the rest of the month off just to make sure that I don't take larger losses, which could affect my emotional constitution, which could affect my behavior of which predicts where I end up in life. Too many younger traders, mostly guys, want to be bullheaded and want to stay in their will and say, well, I'm just going to trade out of it and just kind of further the losses and further the drawdown. And I know I might be preaching to the choir here because this is the abundance of the emails that I get. I'm in a losing streak. I'm pissed. I don't want to be here. So I'm just going to try to trade my way out of it. Position sizing goes completely out the window because what they're thinking about is the distance between where they were, where they are now, and what kind of position size they would need to put on to recover that amount of money. It's a quick way to lose a lot of money, actually, especially if your trading style is not in tune with what's going on in the marketplace. Sitting on your hands is a huge asset. As a speculator, you have the right to not participate. So I would exercise that right as much as you possibly can because at least you'll have the money. You can't say that you're going to miss opportunity, right? That's the devil on your shoulder saying that you need to participate every day. I don't believe that at all. I think even day traders can take time off, and it does wonders for their psychology as well. So anyway, if you're down 2, 3, 4, 5%, you could take off the week, take off the rest of the month. The haircut comes in when you're at, like, say 10. Again, this is a discretionary decision, so it's going to be different for everybody. But I know, when I was coming up, there were guys who were like, if I'm down 10% and I'm trading 90-cent dollars, so to speak, I'm going to actually trade as if I only have 60, right? So the example would be you had $1 million, you lost 100K, you're down at 900,000. So instead of taking 1/2 of 1% or $4,500 at that point in time, the trader's actually going to position size as if they only have 600,000, right? They'll take a 1/3 haircut. The money's still there, of course, but they're going to trade it as if it's a lower notional value. So that would mean 600K would mean my risk unit now at 1/2 of 1% would be $3,000. And the reason you do that is that it forces you then to trade smaller when things aren't working out. Could be human error, could be bad analysis, could be bad luck, could be bad timing. It doesn't really matter at that moment in time because you're losing money. So you want to have to shore up your equity as quickly as possible. You can be more drastic because at that point, the goal is to kind of get back in tune with the market. Don't cut corners, right? If you cut corners, what I would say, and you need to take a flyer, because I spoke to a good friend about this earlier, actually this time last week, in that you want to honor your creativity. You want to honor your sense of intuition, your insight, your feel for the market. However, you don't typically do that with your normal bet size. If you're looking for your setup and it's not quite there, but you have a hunch, I don't like to shut people down, right? Because that's being a dream killer. That's why I don't say don't trade, even to the 19 out of 20 people who fail at it. It's because some of you might actually develop a feel and do it, and then you'll be off to the races. It's not up for me to say don't do it. But if you want to take a flyer and go on a hunch, you think you have a feel, you don't know that that's not the case, even though it sounds like the word hunch kind of seems like it's throwing darts and it's complete guesswork. It very well may be. But you don't know after hundreds, maybe thousands. Like over my career now, I've had millions of observations of watching data points and charts and otherwise time and sales, level 2, this and that, getting information off the floor. So if we have the biggest supercomputer right between our ears, I can't deny the fact that all that information might be somehow, working in the background, and my brain is cogitating in my subconscious what's going on in the marketplace. So you want to honor those bursts of creativity of insight, of potential feel, because that's where the magic could come from, right? I don't know if you could do it after a month of study. Maybe you can't if you're gifted. I don't know. Most people can't. But try it anyway. Here's the rub: do it with 1/10 of 1%, right? Take the flyer, but do it with an option. Do it with something that could only minimize the loss, because if you're going to go on a hunch, the goal at that point isn't to make money, right? Which is like, well, you're like, Mike, don't be stupid. Of course it is. That's why we're trading in the first place. But you don't understand trading it if that's where your head's at. Your job is to develop a system with which you're compatible. If you're going to take a flyer, at that moment in time, you have zero data to make any judgment calls on. So the point is to try it as a process and then repeat that maybe a dozen times or more, where you'll have data to go back and say, my hunch was I was onto something. Let me make this little adjustment here, knowing my position size is deliberately small. Once you know that your new instinct actually works, right, then you scale it. That's how all experimentation in the market should come, is you should always start small with a meaningless position size so that you can get your feel, so that you can determine whether or not, if you're a discretionary chart reader, I'm not talking people who trade purely systematic rules, they already know what the expected value is. But if you're a discretionary chart reader, which is probably 99.9% of the folks watching the show, you have to start small. That's the experimentation part, to get the rules down, to figure out the pattern, to figure out what your instincts might be showing you. Once you figure out that it can make money and it has positive expected value, the scaling part's easy. Too many people start rolling the dice because they're coming off a big week and they're like, yeah, I'm just going to do this trade. And they really have no business being in the trade whatsoever. So now they find themselves down and they're aggravated because they let the hubris of the moment of their other successful trades kind of subvert their overall activity, right? So you want to be mindful of that. Anyway, that's the nuts and bolts of it on trading your P&L, trading your equity curve. If you have any other questions or follow-up, please add to the conversation. I don't care about peacocking or otherwise. If you're doing great, that's perfect. I'm happy for you. If you want to see more videos like this, check out these here.